Hi, I'm Dan Wilton, the CEO of First Mining Gold. First Mining is a project developer with two world-class assets in Tier 1 jurisdictions in Canada. We're moving those forward toward significant milestones in the next 12 to 24 months.
Right, you say that, but look at your share price. It's down. It's been hammered like a lot of precious metal companies, like a lot of companies at the moment. You are a $165 million company. So why should people be buying your stock, your shares?
Well, I mean, we've talked about it before extensively. I'm a big believer in fundamentals, right? And I think whenever you're looking at these environments, market environments like this, as a value investor, you need to be looking at the fundamentals of companies. And the reality is, I think we're sitting in a situation right now where a number of really good stocks are very heavily discounted. This is an environment where and also, I think it's going to get worse over the course of the next couple of months here as we come into tax loss selling. But was at a conference last week, and just the sentiment and what we're hearing around the industry is very much like 2015. So why First Mining? Why now? It's very simple. There are companies that take advantage of opportunities like this, as we have. We've added our Duparquet project and consolidated a 5 million ounce plus gold project in a Tier 1 jurisdiction in Quebec. And we're starting to move that forward and start to surface the value there. At the same time, we've got our 5 million ounce Springpole project moving through the environmental assessment process and the feasibility process. So really advanced stage quality projects in Tier 1 jurisdictions. And I think we will get through this environment. And when we come out of this environment, I think those investors that have taken advantage of some of this discounting that's going on right now, I think are going to see multiples of return.
Okay, but give me. Okay, help me here. Dumb retail here. I need all help I can get. Okay. I want to understand what your looky-likey reference was. 2015. What happened in 2015, which is like today, and what were the outcomes after whatever happened in 2015?
Yeah, so 2015, I'll tell you a little anecdote. I remember I was working as a private equity investor at the time, and I came to a conference in late November in London, and this was amongst the most depressed mining investor sentiments that we had seen. The mining sort of share prices in the market had peaked in April of 2011, and you'd seen 4 years of continuous outflow of capital from the sector. Even just the basic capital for advancing projects was very, very hard to come by. You had some real structural changes in investors in the industry as institutions kind of walked away from the exploration and development sector. And so it was a really difficult time. And the gold price had come down from 1,900 to 1,100. So what we're looking at today looks and feels, from an access to capital and investor interest standpoint, it looks and feels a lot like that time in 2015. But we're sitting with a gold price now, which is, hanging in the mid to high 1600s. It's had a pullback from a couple of pushes to 2000, but the macro fundamental setup today is so much better for gold than what we've seen really any time in the last 40 years, with inflation where it is, where, people in search of safe assets in places where, we're starting to see real challenges to financial systems. This is a time that gold will shine. And I think, interestingly, we get hung up on the gold price in the US dollar. But when you look at the gold price in almost every other currency, it's at or near all-time highs. So gold's doing its job in sterling. It's doing its job in euro. It's doing its job in yen. It's providing that safe haven. But that is absolutely not reflected in the underlying value of the shares of companies that are advancing gold projects.
Right, but okay, I hear what you're saying, but it kind of feels like the usual gold bear, gold bug argument is like gold will do its thing. It's not doing its thing right now. So what's and you're going to say, well, it will. Give it time. It's okay. We've got tax loss season at the end of this year in Canada. Obviously, we'll have an impact. It always does. The charts usually look the same there. But if it is to do its job, when does it do its job? And quite frankly, what's the opportunity for me as an investor? Poor old me. I'm looking for deals. So where are they? How to identify them? Because all companies' charts look the same at the moment.
Yeah, they do. And I think, that's where if I'm looking across the mining company spectrum, you can be looking at, explorers, and a number of explorers with new discoveries are still holding $500 million to $1 billion market caps. You can look at producers all the way up to large cap producers, where you'll have exposure to gold price increase. You'll have some of the operating leverage. But the part of the market that right now is the most unloved and the most on sale is the development sector. And I think if you look across, companies like First Mining, many other companies advancing projects, you've seen those share prices down this year, in many cases, 50 to 70%. Now, ours has held in a little bit better than some, but still, I think you've got that point where this part of the mining sector is so on sale. You're seeing valuations that are 20% of where they would normally be across a cycle. And I think that's where, the industry is going to need these projects. And at some point, when you start getting funds, a flow of funds back into mining developers, I think you'll see these things turn around very quickly. So the opportunity is to get great assets at heavily discounted prices, particularly over the course of the next, 6 to 8 weeks.
Okay, but what I don't want to do is I don't want to get confused with big discounts and good companies. All companies are discounted, some more than others. And it would be easy for me to say, well, they'll all recover to where they were before. So therefore, I'm going to go for the most heavily discounted ones, where they've seen 50, 70% discounts to their, 52-week highs, because that's going to give me the biggest return. Would that be a smart move?
I think you always have to have a very close look at the quality, the underlying fundamental value, and the quality of the assets that are underlying the companies. There are.
So give me that in English, Dan. Give me, you're a finance guy, you're a money guy. Give it to me in English. What does that mean? What am I actually looking for? Fundamental values means what?
I think what you're looking for are companies with large-scale, globally significant projects in tier one jurisdictions, and with significant catalysts coming up over the course of the next 18 to 24 months. That's where you're going to get that multiple bang for your buck.
What's the catalyst mean these days? Because I've seen people put out good DFSs and the market doesn't care. So what does that actually, again, convert into? Do I need to see, the price per ounce in the ground? Do I need to sort of see some sort of economics attached to this? Do I need to see scale? Give me some things I can latch onto.
Yeah, I think the big ones are, particularly germane for what we are doing is advancing through permitting processes, which is one of the things that investors have been avoiding almost at all cost over the course of the last couple of years. But demonstrating progress going through permitting processes to get to those key value milestones, which in the last couple of years haven't been big drivers of share price appreciation, but they have been drivers of strategic interest, which is ultimately the thing that really underpins this value. If you have a really strategic project, at some point, there will be a mining company that needs to build that project. And they haven't been in that position recently, but that will come. So I do think it is putting out compelling economics. I think it's tough to find, feasibility studies that people get really excited about now. There's a high degree of skepticism in an inflationary environment. But you have to put a pin in some of these economics sometime. And, I think still being able to put out something that looks robust in this environment where it's changing, that demonstrates the leverage that you have to an increasing gold price. I think all of those things continue to take risk out of the projects. And when you take risk out of the projects, you should see them reflect higher value going forward.
Okay. And I think one thing I don't think you mentioned here is basically those lucky enough to have cash, whether deliberately timing it right, or there's lucky enough to time it right, are in a better position than most, because it kind of gives the company optionality in terms of how it moves forward and how it progresses as well. I think that's definitely worth noting, because what will happen soon is when companies do need to go to market, the cost of that capital, it could put a hole in the side of the ship.
Yes.
Right?
Yep, absolutely.
That's the real problem.
No, absolutely. And that's the other very important thing to be looking for, companies that are well-financed and have other opportunities potentially other than just raising equity at whatever price they have to in order to move the projects forward. So, for example, in First Mining Gold, we've got a portfolio of other projects that we brought partners in on. We have share interests in those projects. We have project interests. We have royalties in those projects. So all of those things really give us some financial flexibility to have alternatives to just straight equity dilution moving forward.
Yeah, it's interesting. I think time's going to be a killer for a lot of companies as well. So the cost of capital and time for me seem to be are the big ones. So I think, are we in violent agreement here? You basically got to pick the companies with strong fundamentals based on what the asset looks like and what the company's going to be able to do with that asset in the near term, because they've got cash. Management teams who've got a plan and have clearly articulated that helps. And clearly, hopefully, the price of gold, does start to move, or precious metal, or whatever your metals are that you're invested in do start to move, will help. But the kind of cost environment doesn't look like it's going to give much back anytime soon, does it?
I would question that assumption. I think, if we are truly heading into recessionary times, I think you are going to see important changes in the prices of particularly some of the things that really ran away on you. Labor, no. Labor is going to be tough, I think. We're into the beginning stages of a series of wage push inflation, and I think that's going to be really hard to break, and we're not going to break it without some real pain in the economy. But commodity prices of structural steel, and to the degree that construction starts slowing down, sometimes that availability of good quality construction resources, a lot of engineering talent, a lot of those things are going to come back into, long-term averages, as opposed to people who were putting out feasibility studies trying to quantify these things over the course of the last couple of years when, they were doubling and tripling. Your energy costs, for example, over the longer term, I think you want to be cautious about companies that are really, really heavily reliant on diesel, because we've seen that can really pinch. And I think there's situations where it might yet pinch going forward. But, if you have companies that are reliant on less volatile sources of energy connected to electric grids and things like that, I think, you can weather this storm. So, I think those economic studies are important to see come around, and I think they do still help give a real window on that fundamental value of these companies.
Right. I mean, you got to stay in the game to play the game. So are you confident First Mining will be around when we come out of this cycle?
I'm very confident we'll be around, again, by virtue of the fact that we've got a lot of optionality with a couple of big projects and with a number of other assets in our portfolio that give us alternatives to equity dilution. You have to make some hard choices. You always do, but I think those are situations, that you, with more flexibility, you have more alternatives. It tends to breed more alternatives. So.
Right. Okay. And I think I got a quote, slightly threatening quote, from one of your shareholders going, it's obviously it's not Mr. Neumeyer's first rodeo, and is he still behind this and the way that this is playing out with this kind of portfolio approach of yours?
Oh, 100%. 100%. I mean, us acquiring Duparquet was, 6 years on, was fulfilling one of Keith's original visions for First Mining, and one of the favorite assets that he put together. What a lot of people forget, Matt, is that all the projects that we have were acquired the first time in 2015, 2016. our portfolio was put together in that last downturn of the market where these assets were acquired at, $10 an ounce because you couldn't explore for and find ounces cheaper than you could buy them. We're right back in that situation now, right? This is a time with conviction and with a little bit of capital, you can do some really amazing things. And I think we have by increasing our resources by 40% by virtue of the Duparquet acquisition, adding another globally significant project in a tier 1 jurisdiction. Like, these opportunities don't come around very often in a cycle or very often in a career. And we've been able to do that. And in part, we're able to do that because we have great shareholder base that are long-term, supporters and followers of Keith Neumeyer. And Keith is a very actively engaged chair, and really has given us this opportunity that we have by virtue of some of the decisions that he and others made 6 years ago to put this portfolio together.
Okay, so a contrarian's dream. Is that what you're saying?
I like to think that there are more opportunities sitting out here, and I think if you have the capability to pull them together, this is where we're sitting today. We think on, call it a couple of $1 billion of asset value and trading, as you pointed out, at a kind of 160 million market cap. There are more opportunities to be accretive in this environment. You have to be open to them, but this is the time when you can have some really truly extraordinary outcomes by having the flexibility to take advantage of opportunities that come. So it's not just this portfolio that we have, but there are, you always have to be looking for what this opportunity opens up. Because for all that we're wringing our hands and the industry's wringing our hands about valuations, we're still holding on to, a market cap that does give you some flexibility to think about how you might position, to make the company even stronger for the longer term.